Good morning, good afternoon, good evening. My name is Market Maker 69420, and in this episode we're going to talk about the market open and how it affects the economy. As geopolitical tensions in the Middle East drive oil prices to multi-year highs and inject volatility into global market, today's open reflects a risk-off tone in equities, a commodity surge led by energy, and resilient but range-bound cryptocurrency trading. With oil retreating from overnight peaks above 120 to around $100 per barrel, investors are navigating inflationary pressures, economic data previews, and institutional flows amid the ongoing Iran conflict. Let's jump into the stock market. When looking at index futures and pre-market gap, U.S. index futures gapped lower overnight amid the oil spike, with Dow Jones down as much as 1.9%, nearly 900 points, before paring losses. At open, the Dow Jones Industrial Average fell 1% to around 47,501. The S&P 500 dropped 0.6% to 6,740, and the Nasdaq Composite dipped 0.3% to 22,387, reflecting a partial recovery but still signaling broad weakness. Pre-market trading showed initial gaps of 1.1 to 1.5% across majors, driven by energy supply fears through the Strait of Hormuz. When looking at pre-market movers and volume, energy stocks like Chevron and Exxon led gainers with 2 to 5% upside on oil rallies, while travel, airlines down 3 to 4%, and banks down 1 to 2% drag. Tech rebounded modestly, with broadband and Micron up 1 to 2%. Volume was elevated, with S&P 500 futures turnover at 1.25x average, indicating hedging activity amid VIX spike. Top movers included losers like Boeing, minus 2.5% on industrial exposure, and gainers like Occidental Petroleum, plus 4%. When looking at economic calendar and new catalyst, today's calendar featured the NFIB Small Business Survey at 6 a.m. ET, expected 94.8, up from 94.1, and Treasury actions for 13 and 26-week bill at 10:30 a.m. ET. Key catalysts include the Iran war impacts on energy, with G7 discussions on oil reserve release, and a weak February jobs report, minus 29K versus expected flat, amplifying slowdown fears. Upcoming CPI March 11th and PCE March 26th could sway Fed expectations. When looking at market breadth and internals, breadth is negative, with decliners outpacing advancers 4-1 on New York Stock Exchange. Advance decline line shows weakening momentum from last week's 2 to 5% losses across indices. New high-low ratio favors lows, with small caps Russell 2000 minus 1.2%, underperforming amid inequality concerns from energy costs. Internals point to defensive rotation into staples plus 0.5%. When looking at volatility, VIX surge above 30, highest since April 2025, up from 20 last week, reflecting tariff and war fear. Intraday spike to 35 signals hedging demand. This fear gauge gap underscores twitchy sentiment, though history shows quick rebound from similar conflicts if oil stabilizes. When looking at technical setup, S&P 500 testing support at 6,650, down 3% year to date, with resistance at 6,850. RSI oversold at 33. MACD bearish crossover. Dow below 47,500, risks 46,800. Nasdaq's falling wedge suggests potential rebound to 22,700 if oil cools. When looking at sector leaders and macro links, energy leads plus 3 to 5%, followed by materials, tech 0.5%, rebounds on lower yields, while cyclicals like industrials minus 2% and financials minus 1.5% lag. Macro ties, oil 12 to 25% surge linked to inflation, 10-year yield plus 4 basis points to 4.17%, Fed hold through 1H26, and Q4 GDP slowdown 1.4% SAAR. When looking at positioning and sentiment, pros see dips as buys, with S&P within 5% of January highs. Sentiment bearish, but Q4 earnings plus 13.7% provide buffer. Positioning short coverage in tech, but overall risk off with tariff worries. Moving on to the commodities market, when looking at gaps from prior settlement and initial momentum, WTI crude gapped up 13 to 25% from $92 to $103 overnight, peaking at $120 before settling at $100, plus 5% from Friday's close. Brent similar, up 16 to 25%. Initial momentum faded on G7 reserve release talk, but war risks sustain upside bias. Looking at key reports and inventory data, EIA crude inventory, March 6 expected plus 439 million barrels. Natural gas plus 1,886 BCF. War disrupts Hormuz transit, 20 to 25% global oil, with Kuwait, EAU, Iraq cuts filling storage rapidly. FAO forecasts 810 MT global wheat production down on lower plantings. And looking at US dollar correlation, dollar firmer 0.2% on safe haven flows, pressuring commodities. Oils rally decouples, boosting energy despite US dollar strength. Gold down 1 to 2% to 5,100 per ounce on rates outlook. When looking at technical indicators, WTI RSI overbought at 75, MACD bullish, gold RSI 33 oversold, super trend bearish, soy oil surge 184 to 68.42, and palm plus 9%. When looking at supply, demand, and macro drivers, supply squeezed by Hormuz closure and production cuts, demand hit by slowdown, Q4 GDP 1.4%, but biofuels boost vig oils. Macro inflation from energy widens inequality, hits consumers, stock to use 31.9% for grains comfortable. When looking at commodity indices and benchmark, Bloomberg Commodities Index up 3 to 4%, CRB plus 5% on energy, aluminum plus 4% on supply fears, wheat plus 5 to 7 cents to $6.21. Looking at liquidity and volatility window, CME energy volume hits record 8.3 million contracts, March 6th, volatility high, oil IV 45%, with Asia-Europe sessions driving gap. Liquidity thin overnight, amplifying moves. Moving on to the cryptocurrencies market. When looking at overnight Asia sessions and gap, Bitcoin gapped up 1 to 3% in Asia from 65,600 low to 67,500, decoupling from equities. ETH plus 0.3% to 1,940. Asia volatility tied to oil, but BTC resilient as head. When looking at correlation and risk asset, BTC up 1% while stocks down 1%. VIX spiked to 35 aligns with past BTC bottoms like the 2024 yen unwind, less correlated to oil equities acting as 24/7 safe haven. When looking at on-chain metrics, real-time snapshot, long-term holders plus 41K Bitcoin 30-day net, whales 1K plus Bitcoin addresses up to 1,280. Active addresses 643K down from 765K peak. Profit taking less than 5 million per hour. Caps rally. Supply 20 million Bitcoin. Miner break even is 64,635. Transactions are moderate. Network growth is declining. When looking at derivatives data, open interest up with top exchanges like Binance showing mixed long shorts. BVIV suggests crypto panic peaked in February. Volume 37 to 56 billion, up 53%, implying 150 to 170 billion true liquidity incentive OTC. When looking at ETF flows and institutional signals, 568 million inflows March year to date, ending 4-month outflows. Spot ETF plus 1.47 billion past 2 weeks. BlackRock leading. Kraken's Fed access signals regulatory shift. Institutional accumulation via MicroStrategy plus 3K Bitcoin. When looking at technical setup, Bitcoin in 62.5K to 74K range, testing 70.5K pivot. RSI 33 oversold. MACD bullish hint. ETH falling wedge support 2020. Dominance at 0.786 suggests alt outflows. When looking at news and sentiment, prediction markets favor Bitcoin 68K. Sentiment cautious but improving. War boosts Bitcoin as hedge. CPI on March 11th will be key. Bitcoin on-chain holder accumulation versus bearish volume lag. In summary, today's market open underscores a fragile balance. Equities reeling from energy shock and growth fears. Commodities buoying by supply disruptions, and crypto showing relative strength through industrial inflows and on-chain accumulation. While short-term volatility persists amid war risk and upcoming inflation data, resilience earnings and potential oil stabilization could support a rebound, though sustained downside pressure remains if tensions escalate. That's all I got for you guys today. Don't forget to like, comment, and subscribe if you enjoyed the content. If you'd like to support the channel, feel free to buy me a coffee on Patreon. Thank you. Bye-bye.